morning, sir. Good morning, classmates. Today we will be discussing financial market. First, let me give you the commonest meaning of a market. A market is a place used for buying and selling goods. The usual feature of a market are place, some buyers, some sellers, some commodity to be exchanged for money. The definition of financial market is a market in which people trade financial securities and derivatives at low transaction costs. Some of the securities include stocks and bonds, raw materials, and precious metals. In an ordinary market, what is usually exchanged is physical commodities such as fruits, grains, vegetables, and etc. The difference between financial market and in an ordinary market is the commodity that is being traded. In our economy, there are various economic units such as individuals in households, businesses, commercial sectors, and even government organizations that are engaged in various activities and transactions involving money. Some of them spend money than they earn and end up in financial deficit, while others earn money than they spend, thus ending up in financial surplus. When we say financial deficit, it is a shortfall in income compared with its spending, meaning to say they spend more than they earn. While financial surplus, it describes the amount of an asset or resource that exceeds the portion that's actively utilized, meaning to say they earn more than they spend. The deficit generators, who are known as the ultimate borrower, would like to borrow funds from the surplus generator, who are primary lenders. So deficit generator usually in the units of businesses, commercial sectors, and government organization, while the surplus generators are mostly in the units of the household. So let's move now in the segments of the financial market. Different types of securities are traded in the securities market. This may include ownership securities, debt securities, short-term securities, long-term securities, government securities, non-government or corporate securities. There are two segments of financial market. Number one, money market. The money market is a segment of financial market in which financial instruments with high liquidity and very short maturities are traded. Meaning to say, money market is a market for short-term financial assets with maturity of 1 year or less. The money market is used by participants as means for borrowing and lending in short terms for several days to just under a year. Money market securities consist of negotiable certificate of deposits, bankers' acceptance US Treasury bills, commercial papers, municipal notes, and even euro dollar. The another segment of financial market is the capital market. Capital market is one of which individuals and institutions trade financial securities. Organizations and institutions in the public or even in private sectors are often sell securities on the capital market in order to raise funds. These types of market is composed both the primary market and secondary market. The difference between money market and capital market is the maturities of the securities that is being traded, wherein money market, they trade short-term and low-risk securities, while in capital, it includes longer-term and riskier securities. The next topic is the types of financial market. There are two types of financial market, namely primary market and secondary market. Primary market are where securities are created by companies, while secondary market is where those securities are traded by investors. So the types of financial market, it can be classified as primary market or secondary market depending on whether securities traded are newly issued securities or securities already outstanding and owned by investors. The example of primary market is when companies sell new stocks and bonds to the public for the first time, while in secondary market, it deals with securities which have already been issued and owned by investors. Both individual and institutional securities may be traded between investors. So the difference between primary market and secondary market is depending on whether securities traded are newly issued securities or securities that is already outstanding and owned by investors. Primary market is also termed as new issues market because it deals with new issue of securities. While secondary market is termed as stock market because investors trade among themselves. An example of secondary market is When if you go to buy Amazon stock in Amazon company, you are dealing only with an investor who owns shares in Amazon. Amazon is not directly involved with the transaction. Primary and secondary market is used as a key to understand how stocks, bonds, and other securities trade. Without them, the capital market would be much harder to much less profitable. Let us discuss now the participants in the financial market. The system is composed of participants, securities, markets, trading arrangements, and regulation. The major participants are the buyers and sellers of securities, or the investors, who are the buyers of securities, and the issuer, who are the seller of the securities. Second major participants of financial market is the financial intermediaries. So, they play a crucial role in smooth functioning in the financial system. Investors who are primary lenders in the financial system would prefer to lend short, and meaning to say, they invest their surplus for short duration, while issuer of securities who are the ultimate borrowers would prefer to borrow long, meaning to say, they borrow for long duration as the funds are generally required for financing long-term investment in fixed assets. So the problem now is to match the preference of the surplus sectors to lend short for those who of the deficit sectors to borrow long. So the problem now is being resolved by the financial intermediaries. Financial intermediaries is an institution or individual that serve as middlemen such as commercial banks, banking institution in short. There are two types of financial intermediaries. First, the banking financial intermediary and the non-banking financial intermediary. Intermediaries such as insurance companies, housing finance companies, and etc. As a result of technological innovation and increasing competitive pressures, the traditional distinctive between banking and non-banking activities is rapidly disappearing. And now there is the presence of universal banking system in which a single institution provides the complete range of financial intermediation services is slow emerging. So meaning to say, these two types of financial intermediaries are disregarded because there is not the presence of universal banking, which it can render the complete range of these two types of financial intermediaries. Another group of participants in financial market comprises of individuals and institutions who facilitate the trading or exchange process in the system. They are primarily brokers who act as agents for primary lenders or the ultimate borrowers in purchase or sale of the securities. So let's move now in the regulatory environment of the financial market. The financial system in a country is subject to set a regulation in the form of various acts passed by legislative bodies. The regulatory control of financial system is exercised by designated regulatory authorities. So the transfer of funds from the savers to the spenders is in the help of financial intermediaries, which is the banking institutions. So during the transaction, they are bound with the regulations set by the regulatory bodies. So regulatory bodies or the regulatory body is a public authority or government agency responsible for emerging autonomous authority over some places. To explain more, the securities thus issued may be traded or exchanged between investors in securities markets with the help of the intermediaries with the regulatory framework approved by the government or regulatory bodies. Example of regulatory bodies found in the Philippines is the Bangko Sentral ng Pilipinas, Philippine Stock Exchange, and Philippine Securities and Exchange Commission, and so more.
Our topic for today is primary market or new issues market. When a new company is floated, its shares are issued to the public in the primary market as an initial public offer or IPO. If the company subsequently decides to include debt in its capital structure by issuing bonds or debentures, this may also be floated in the primary market. Similarly, when a company decides to expand its activities using either equity finance or bond finance, the additional shares or bonds may be floated in the primary market. The primary market or new issues market or NIM does not have a physical structure or form. All the agencies which provide the facilities and participate in the process of selling new issues to the investors constitute the NIM. The new issues market has three functions to perform. They are origination, underwriting, and distribution. Origination is the preliminary work in connection with the flotation of a new issue by a company. It deals with assessing the feasibility of the project, technical, economic, and financial, as also making all arrangements for the actual flotation of the issue. As part of the origination work, decisions may have to be taken on the following issues. First is time of floating the issue. Means is crucial for its success. The flotation of issues should coincide with the buoyant mood in the investment market to ensure proper support and subscription to the issue. Second is type of issue. Type of issue, whether equity, preference, debentures, or convertible securities, has to be properly analyzed at the time of the origination work. Third is price of the issue. Pricing the issue is the sensitive matter, as the public support to a new issue will depend on the price of the issue to a large extent. The pricing of new issues is also regulated by the guidelines on capital issues issued by the SEBI. The second function of new issues market is underwriting. The second function performed by NIM is underwriting, which is the activity of providing a guarantee to the issuer to ensure successful marketing of issue. An underwriter is an individual or institutions which gives an undertaking to the stock issuing company to purchase a specified number of shares of the company in the event of a shortfall in subscription to the new issue. The stock issuing company can thus ensure full subscription to the new issue through underwriting agreement with different underwriters, even if there is no proper response to the new issue from the investors. Underwriting activity in the new issues market is performed by large financial institutions such as LIC, UTI, IDBI, IFCI, general insurance companies, commercial banks, and also by brokers. Lastly is distribution. This third function is that of distribution of shares. The distribution function is carried out by brokers, sub-brokers, and agents. New issues have to be publicized by using different mass media, such as newspapers, magazines, televisions, radio, internet, etc. New issues are also publicized by mass mailing. Next reporter is Karen Foronda.
Good morning, sir. Good morning, classmates. Today, I will discuss about the methods of floating new issues and the principal steps in floating a public issue. Methods of floating new issue. First, public issue. Second, rights issue. And last, private placement. Public issue. Public issue involves sale of securities to members of the public. The issuing company makes an offer for sale to the public directly of a fixed number of shares at a specific price. The offer is made through a legal document called prospectus. Thus, a public issuing is an invitation by a company to the public to subscribe to the securities offered through a prospectus. Public issues are mostly underwritten by strong public financial institutions. This is the most popular method for floating securities in the new issue market, but it involves an elaborate process and consequently, it is an expensive method. The company has to incur expenses on various activities such as advertisements, printing of prospectus, banks commissions, underwriting commissions, agents fees, legal charges, and etc. Next is rights issue. The rights issue involves selling of securities to the existing shareholders in proportion to their current holding. As per Section 81 of the Companies Act 1956, when a company issue additional equity capital, it has to be offered first to the existing shareholders on a pro rata basis. However, the shareholders may forfeit this special right by passing a special resolution and thereby enable the company to issue additional capital to the public through a public issue. Rights issue is an inexpensive method of floating of shares, as the offer is made through a formal letter to the existing shareholders. Private placement. Private placement is the sale of securities privately by a company to a selected group of investors. The securities are normally placed in a private placement with the institutional investors, mutual funds, or other financial institutions. The terms of the issue are negotiated between the companies and the investors. A formal prospectus is not necessary in the case of private placement. Underwriting arrangements are also not required in private placement as the sale is directly negotiated with the investors. This method is useful to small companies and closely held companies for issues of new securities because such companies are unlikely to get good response from the investing public for the public issues. They can avoid the expenses of public issue and also have their shares sold. Principal steps in floating a public issue. In a public issue, investors are allowed to subscribe to the shares being issued by the company during a specified period ranging from a minimum of 3 days to a maximum of 10 days. The issue remains open during this period for subscription by the public. This is the principal activity in the process of a public issue. Before the issue is open for public subscription, several activities or legal formalities have to be completed. These are the pre-issue steps or obligations. Similarly, after the issue is closed, several activities are to be carried out to complete the process of public issue. These activities may be designated as the post-issue tasks. There are three distinct stages in the successful completion of a public issue. First, the pre-issue task, opening and closing of the issue, and last is post-issue task.
Good day everyone, I am Shaila Lazarobul and I am going to discuss and explain those three distinct stages in the successful completion of the public issue. These are the pre-issue task, opening and closing of the issue, and the post-issue task. Pre-issue task. These are the preparatory obligations to be complied with before the actual opening of the issue. Drafting and finalization of the prospectus. Prospectus is an essential document in a public issue. The Companies Act 1956 defines a prospectus as any document described or issued as a prospectus and includes any notice, circular, advertisement, or other document inviting deposits from the public or inviting offers from the public for the subscription or purchase of any shares in or debentures of a body corporate. There are four important categories of intermediaries. So first, we have the merchant banker. Merchant banker is any person or institution which is engaged in the business of issue management, either as manager, consultant, advisor, and etc. Merchant bankers play an important role in the process of managing a public issue. It is a duty of the merchant to ensure correctness of the information furnished in the prospectus. So, the second is the registrar to an issue. Registrar to an issue is any person or institution entrusted with the following functions in connection with the public issue. Collecting applications from investors, keeping a record of applications and monies received from investors, assisting the stock issuing company in determining the basis of allotment of securities in consultation with the stock exchange, finalizing the list of the person entitled to allotment of securities, processing and dispatching allotment letters, refund orders, certificates, and other related documents.
The third one is the share transfer agent. Share transfer agent is a person or institution which maintains the records of holders of securities of a company on behalf of that company. The share transfer agent is authorized to effect the transfer of securities as well as the redemption of securities wherever applicable. And lastly, we have the banker to an issue. Banker to an issue is a scheduled bank entrusted with the following activities in connection with the public issue:
Acceptance of application and application monies, acceptance of allotment of call monies, refund of application monies, payment of dividend or interest warrants. Opening and closing of the issue. The public issue is open for subscription by the public on the pre-announced opening date, which two closing dates are prescribed for the closing of the public issue.
the earliest closing date, which should not be less than 3 days from the opening date. If sufficient applications are received by the company may choose to close the issue to the earliest closing date itself. The other closing date is a final or latest closing date which shall not exceed 10 days from the opening date.
Post-issue task. After closing all the public issue, several activities are to be carried out to complete the process of public issue. They are: first, all the application forms received have to be scrutinized, processed, and tabulated. Second, when the issue is not fully subscribed to, it becomes the liability of the underwriters to subscribe to the shortfall. The liability of each underwriter has to be determined. When the issue is oversubscribed, the basis of allotment has to be decided in consultation with the stock exchange. Fourth, allotment letters and share certificates have to be dispatched to the allottees. Refund orders have to be dispatched to the applicants whose applications are rejected. And lastly, shares have to be listed in the stock exchange for trading. For this purpose, the issuing company has to enter into the listing agreement with the stock exchange.
So our next topic is all about book building. Companies may raise capital in the primary market by way of public issue, right issue, or private placement. A public issue is the selling of securities to the public in the primary market. Under the book building process, the issue price is not fixed in advance. It is determined by the offer of the potential investors about the price which they are willing to pay for the issue. Under the book building process, the issue price of the security is determined by the demand and supply forces in the capital market. Book building is a process of price discovery. It puts a place in pricing mechanism whereby securities are valued on the basis of the demand feedback following a period of marketing. It is an alternative to the existing system of fixed pricing. Next is all about the role of primary market. Primary market is a medium for raising fresh capital in the form of equity and debt. It moves up resources from the public or investors and make them available for meeting the long-term capital requirements of corporate business and industry. The primary market brings together the two principal constituents of the market, namely the investors and the seekers of capital. The savings of surplus funds with the investors are converted into productive capital to be used by companies to productive purposes. Thus, capital formation takes place in the primary market. The economic growth of a country is possible only through a robust and vibrant primary market. Lastly, we have the regulation of primary market. For companies, raising capital through the primary market is time-consuming and expensive. The issuer has to engage the services of a number of intermediaries and comply with complex and other formalities. The investor faces much risk by operating in the primary market. Fraudulent promoters may invest a new issue. Investors in the primary market need protection
such fraudulent operators. Successful flotation of a new issue in the primary market requires careful planning, proper timing, and comprehensive marketing efforts. The services of specialized institutions such as merchant bankers, registrars to the issue, underwriters, etc. are available to the issuer company to handle the task. There is effective regulation at every stage of a public issue. There are also regulations to ensure fair practice by the intermediaries of the market.